If you've been a long-time subscriber to the channel, you know that I focus on real estate investing. I flip properties, I accumulate residential rentals, and I have Airbnb rentals, and generally have my eyes open to buying internationally. In today's video, I'm talking about why I've stopped flipping houses. My name is Carl Pierre, and this is ENTP Life. On this channel, I share how I live globally and give strategies on how you can too. If this is the type of content that you want more of, subscribe to the channel and use the comment section below to ask questions or suggest what city I should cover next. Ever since July 2020, I stopped buying real estate in the United States to flip, and here's why. When the world shut down because of the pandemic, I never saw market conditions in this shape. The market was in free fall, and it really was a scary time. And I anticipated that banks would be a little more resistant to lending. And for a moment in time, they stopped issuing new mortgages, and the lenders that I worked with kind of took a pause and was waiting to see what was going on in the market. Since I've never seen conditions like this, I was even more hesitant to pull the trigger on anything until I found a really good deal that made sense for me because I saw that it would have potential to be a primary residence for myself and my family while generating income on Airbnb, ultimately offsetting my rental expenses that I had in Florida. The property itself was selling for what was land value at the time. So that meant that I was getting a 3-family house that I could use that will cash flow, bring my rent to zero. And for that reason, I decided that I would buy this property cash and not really be at the mercy of mortgage lenders or feel that I was at risk because of market volatility. At the time, similar properties were selling for $900,000, so I was already getting it at 2/3 market price. The last property that I bought, I got for $600,000, and it currently has a mortgage of $750,000. Just the other day, my neighbor's property sold for $1.55 million, which is just crazy to me as it's a bit dated. It also has 3 units and it's similar square footage to my home, which means that it could be used as a comp and my property value just went up. The original plan with this house was to tear it down and build townhouses in its place, but that's another story that I'm going to touch on a little bit later. The last recession that I lived through was the housing market crash, and the real estate market got crushed. Fortunately for me, the years that followed were a great time to build on my portfolio. I know time in the market isn't recommended by most, but I still apply some logic and reason to when I should buy and when I should not. This is what has led me to not be a buyer at this time. Time in the market can be quite tricky because you're more or less playing a game of hot potato, where you're thinking that I'm going to buy an asset today in hopes of selling that asset for a higher price to somebody else. And if you think that market conditions are going to be good at some point in the future, you're going to be a little more confident about playing that game of hot potato. However, if you're doing this purely on speculation, rather than buying assets at a discount that you know are already undervalued, you're playing a hot potato game that is dependent entirely on the next buyer being able to buy that asset for more than what you paid for it, which is exactly the reason why if you're investing in real estate or any other asset class, you shouldn't pay market price only hoping for that product to go up in price, and that's how you make your money. That's really a bad idea and plays into the whole time in the market situation. You could only pay what you think an asset is worth, but if you're buying always at a discount and you're buying the best assets that are available to you at that time, you're continuously accumulating those assets, and as market conditions improve, then those asset values will go up, and it's not purely speculative, and you're not dependent on only the market conditions rising to improve the value of the underlying asset. Flipping depends heavily on 2 things: favorable lending conditions and distressed properties being sold at attractive price points. Let's take the example of a $1 million property with a 3% interest rate. That $1 million property will have a payment of around $3,000 to $3,500 per year on a 3% interest rate. You take that same property and you boost the interest rate to 6%, at a market value of $1 million, that same property is now costing $6,000 a month, which is a substantial difference on a month-to-month basis for someone who is really looking at their monthly spend to determine where they're gonna live. A payment of $3,000 and a payment of $6,000 is significantly different for someone who's making $10,000 a month. So the person who could afford $3,000 in a 6% interest market environment is going to look at properties that are now priced at $500,000, which ultimately puts more pressure on more expensive real estate. And all the real estate that exists in a market is going to go through somewhat of a contraction if interest rates are too high, because the month-to-month affordability of that property goes up. Also, if lenders aren't free with the money and are increasing the requirements to qualify for mortgages, it shrinks the pool of potential buyers. So that's also going to limit the demand for real estate. If there's less people who have loans available to them to go ahead and buy real estate, then there's going to be less buyers in the market. Remember when I said I planned on tearing down the house and building new townhouses in its place? I'm glad that I didn't. Back in July 2020, interest rates came really down, and they stayed down for about a year's time. And of course, that stimulated the economy overall. And a lot of free money and cheap money came to market in the United States in the form of PPP loans, in the form of just easing that was taking place to ensure that businesses stayed afloat and people stayed afloat while everything slowed down due to the pandemic. Now, that created a situation where, again, interest rates were super low, so higher asset prices were more tolerable to people. Remember, I gave you that example. $1 million home only costs $3,000 a month when interest rates are 3%. When right before that, interest rates were closer to 5%, and that same $1 million home would have cost somebody $5,000 a month. All of a sudden, it seems that that property is on sale, and there's more interest in that at that price point because rates are so low. Now, what I saw was that those low interest rates, or interest rates at near zero, as far as the lending rate from bank to bank, were near zero. I was like, this can't be sustained for too long. And I knew that it was going to take me about 2 years from beginning to end, if there were no delays, to complete the project. So that would have put me right at today's time, summer 2022, where interest rates are knocking on 6%. So all projections I would have had to account for what happens if there's delays in construction, which we all saw happen because of the interruption with the supply chain. Values of materials have gone up wildly. All of the calculations that I was doing to build, I just couldn't accept the risk of what is the future going to hold 2 years from now. This condition, this environment just doesn't seem stable enough for me to take on the risk of building out 3 townhouses with the expectation that interest rates will stay reasonable. What if at this time interest rates were 8%? I'd be getting absolutely crushed because nobody would be buying properties at 8%, and the prices that I was anticipating would be depressed. So again, I'm glad that I decided to renovate that property rather than being in this period where the Fed is announcing interest rate increases almost every quarter. Since I've talked about what's made me stop, I'll tell you what will make me start flipping again. Overall, buying needs to slow down. Rent prices need to stabilize, and the market needs to go through a healthy correction. All markets. I'm not trying to get caught with my pants down holding real estate that I can't sell. As interest rates rise, mortgages get more expensive and home prices usually go down. The change in market value will erode the equity that I'm counting on to make some coin. Without a correction, I will only entertain deals at a deep discount, which are harder than ever to come by. Until that time, I will only purchase properties that will produce cash flow above preferred interest rates and that outpace inflation. That's quality rental properties and vacation rentals in peak markets where there's healthy employment and travel interest. Again, very hard to find in this market. I have a course where I show how to invest, and I don't even promote it right now. I truly believe now is not the time for people to start investing, but potentially a good time to start learning. It's a great program to learn what to do once the recession passes, but this environment is just too sketchy for me to advise anyone new to investing to start investing in this market, even if that means that I miss out on potential course sales. At present, I'm focused on cashing in by selling my worst performing properties and being on the lookout for recession-resistant assets or rental properties that are a no-brainer investment. Do you think I'm making a mistake? Let me know by using the comment section below. Until the next one, take care.